Back in the 1970s and 1980s, there was a pretty famous commercial put out by a brokerage firm called E.F. Hutton. And it would always be like in a restaurant or a hotel or some busy place where people are functioning. And then one person sitting at a table would say, well, my broker at E.F. Hutton says, and everybody would stop and listen in, like, what's E.F. Hutton saying? And it was a pretty famous commercial back then. If you're a millennial or Gen Z, or you have no idea what I'm talking about. But in the financial planning field, there are actually people that I sit and listen to. Like when they talk, I listen. And some of those names are pretty well known. If it's Warren Buffett, most people know who Warren Buffett is. So, when I talk about what he said or what, more importantly, what he's doing, it carries some weight. But there are a lot of other people that I really focus on. And I wanted to look at a Bloomberg video that was posted recently with an extended interview of Jeff Gundlach. So Jeff is the founder of Doubline Funds. You probably have some Doubline bond funds in your 401k plan, and you might not even know it. But Jeff is now considered the bond guru, the bond king. He took that title from Bill Gross, who had it in the 80s and 90s when he was the head of PIMCO mutual funds. Well, Jeff worked at PIMCO and then eventually went off and started Doubline. And really, if you go back and look at his interviews through time, this guy's been pretty spot on in what he's talking about. And not just in the bond markets, although that's clearly his specialty, but obviously everything affects the bond market. I've talked about it a million times. The bond market is the real market. It's 6 times the size of the stock market. The bond market's the big brother, the stock market's the little brother. So you really, if you want to understand what's going on in the financial world, you need to understand the bond market. So I just wanted to, start off with this video. We'll stop and talk occasionally, and I'm not going to show the whole video, but we'll get into a good part of it because it really hits upon some of the things I've been talking about in previous Coffee with Kirks.
Considering the fact that you've talked about how the U.S. is going to go bankrupt and how it's on an unsustainable fiscal path, are we seeing that priced in, or is there still a reckoning to come?
Well, it's certainly behaving differently than it was for the last 4 decades. I mean, what we've seen is in the last 15 years, there's been a number of corrections on the S&P 500. And in every single one of them, when the S&P goes down more than 10%, the dollar index, the trade-weighted dollar index goes up. This time, the dollar went down when the S&P 500 went down almost 20%. That's strange. Things are behaving differently. Usually when the Fed starts cutting interest rates across the yield curve go down. The 10-year Treasury almost always goes up immediately following the first Fed rate cut, and then it keeps rallying for a while. This time, the 10-year yield went up, and the yield curve is steepening. So I think what we have is a recognition that the interest expense for the United States is untenable if we continue running a $2.1 trillion budget deficit and we continue to have sticky interest rates. One thing that people fail to appreciate is how much the average Treasury payment has gone up. The average yield.
Okay, so I just want to kind of stop right here and discuss this a little bit. So at the time of filming here, this is right after the big, beautiful bill was passed through the Senate and the House and is now heading to the president's desk for signature, which it will undoubtedly get. And, I don't want to get in the politics here, but let's focus strictly on what Gundlach's been talking about and the debt and how that's going to affect the Treasury markets. And I just wanted to jump into somebody else who is kind of a guru that I absolutely listen to and follow quite a bit. And that's Ray Dalio. And he is he's a hedge fund manager, one of the largest hedge funds in the world. And this is a Twitter post that he just put out there, essentially saying that with this big, beautiful bill, we're essentially guaranteeing that we're going to continue with $2 trillion deficits going forward. We're bringing in about $5 trillion a year in tax revenue, and this is pretty much still going to continue us to be spending $7 trillion a year. Now, I know a lot of people are going to say, oh, but it's got this in it, it's got that in it, and that's great for America. Okay, but let's focus in on just the numbers. And you can kind of, I'm not going to read all of this, but you can kind of jump in there and see what the real effect is going to be. And the biggest issue that I've got is we're getting to the point right now, we're going to be spending about $1 trillion in interest alone this year. So $1 trillion, that's $1 trillion for no services for the American people. That's just pure interest. And this is a bipartisan issue. This has been Democrats and Republicans that have been absolutely fiscally reckless for a long time. And we've gotten away with it for a long time. But we're getting to that point where it's going to get to be a problem, just as Gundlach laid out here. We're already starting to see historical correlations break down. Usually when the stock market goes down, the dollar will rally. It didn't this time. Also, when the stock market breaks down, treasuries usually do quite well. They didn't this time. When the Fed cuts rates, usually longer dated treasuries also come down in yields. It didn't this time. So there's something happening here. So maybe all of these decades we've had these fiscal deficits and it hasn't really impacted us. Maybe it's changing. And the way we're headed now with higher interest rates, and I think Gundlach will talk about this in a second, but we're going to get to the point where we'll have $2 trillion in interest payments in the not too near distant future. So even at $1 trillion in interest right now, we're spending as much on interest as we are the military. So this is certainly an issue that you have to be thinking about as an investor. So let's jump back into the discussion with Gundlach.
Yield, the average coupon on treasuries was below 2%. The entire treasury market, all 30 odd billion of it, you average it all together. Some of them are old, they were issued with higher interest rates, but it was below 2%. Now it's pushing 4%. And as long as bonds are maturing, and there's trillions and trillions of dollars of them maturing, a lot of them were issued back in 2009, 2008, these other time periods. Even if you just issued them in 2019, some of these are starting to come due. And they were issued with coupons of 0.25%. And now it's 4.25%. So it's 400 basis points higher. So,
and just the sheer loan, so you can get a kind of a feel of the 37 trillion of debt that we have. In this year alone, we're going to have $9 trillion mature. So they're going from these lower rates that Gundlach was talking about, and we now have to refinance them at a maybe 2% higher than what they were when we initially authorized those. So a new bond coming due is probably going to be a 2 to 4% higher interest rate than what we had before, and that's huge.
So this problem continues to build, and there's an awareness now that the long-term treasury bond is not a legitimate flight to quality asset. It's not responding to lower interest rates. It's not really responding to an inflation rate, which is now 2.5%, probably going to go higher on the inflation rate because the ones that are rolling off from a year ago, I mean, the cumulative, I think, headline CPI that came out today, it was a 0.18, but the one that was rolling off, I think, was 0.1. And if you do the next 2 months, those 3 months together that quarter, the cumulative rise from a year ago was 0.1. So we're likely seeing the low point in near-term inflation. So yeah, I think the reckoning is coming, is that we have to somehow figure out how we're going to deal with $37 trillion. I mean, we're actually going to hit the 37 trillion number for real. It's still 36.95 trillion, but it's going up quickly. So yeah, there's going to have to be some pretty creative thinking, and the market's starting to believe that. So the previous group talked about capital flows, and one of the reasons that the U.S. is underperforming at this point is so much money came into the United States since, say, 2015 or so, or 2005, and there was a net investment position. Foreigners were investing more in the U.S. than the U.S. was investing outside the country, to the tune of $3 trillion. That was about 15, 17 years ago. It's now over $25 trillion is the net investment position, and the dollar is falling. So it's not inconceivable that some of that $25 trillion that came in over just a couple of, not even 2 decades, could go out. And so this is a moment where finally you have the setup where non-US investment, even if you're a dollar-based investor, you should be thinking about increasing your allocations to non-dollar investments. And it's already working. It's already working.
Okay, and I've talked about this previously, and let me show you a quick little graph here. But we've had this as an issue before, and I've said we're probably at a point now where starting to add some international is going to be a really good idea. Specifically on stocks. I've been talking about stocks, but also on probably bonds as well. This chart that I'm showing you here is the U.S. stock market compared to international stocks. And it's a 5-year monthly rolling returns. But everything in life is cyclical, including the markets. So there are periods where international outperforms the U.S. and periods where the U.S. outperforms international. And really, since 2009, we've had a period where the U.S. has absolutely crushed the international markets. Like you have been an idiot to have diversified into international. And I have had international the whole time because you want to have a diversified portfolio. But we're getting to the point now where maybe we'll have a period where international is going to outperform the U.S. And I know that's probably hard for people to believe because it's been so long since we've had a period where internationals outperform. But even if you start to look at valuations, it makes sense. So this is comparing the Vanguard Total Stock Market, which is the U.S. market, and the Vanguard Developed Markets Index. So this is developed international markets. This is not emerging markets. Emerging are countries like China, South America, India, Eastern Europe. So we're talking developed, Western Europe, Japan, Korea, Australia, New Zealand, those kind of markets. And if you look at from basically every kind of metric, price to earnings, it's much cheaper to buy the developed markets outside the US. Price to book, which is essentially assets minus liabilities, price to sales is way lower, price to cash flows, the dividend yield, you're getting double the dividend yield for investing in international as opposed to the US. So, we're kind of at a point where you are going to be rewarded to actually diversify out your portfolio. And it's certainly something to be thinking about, as an investor. So let's jump back to Gundlach and listen a little bit more to what he's got to say here.
So there's so much to unpack there. I want to talk about the idea that there could be this 25 trillion or some of it that moves away from the US.
Trillion.
Right, exactly. Yeah. Whatever it is, yeah. 3 trillion. You're getting trillions of dollars moving out of US assets.
Yeah.
How high or what kind of behavior do you have to see in the 30-year bond to like it again, given the fact that you've been very vocal
I've been
about
thinking about this for a long time, and I've come to the idea that as the Fed eases, and when the economy really does weaken more, the Treasury rate will continue to go up at the long end. And so for now, we're very uninvolved in the long-term Treasury bond. But there will come a moment where you have to pivot because there's going to be a response. And I've got many ideas of what that response might be, but one of the leading candidates would be quantitative easing. So you get to a point where the rate is so uncomfortably high. What is that number? I'm going to guess 6%, where they say, this is going to be something that we're going to be running a $5 trillion budget deficit with all this bond issuance when we go into a recession. And so they'll pivot. I believe this is a sensible idea. There's other ideas too, but the leading candidate is they will announce quantitative easing on buying long-term treasuries. And when they do, you have to very quickly, and hopefully you do it the day before they announce it. But we don't have access to the day before stuff. That's for the primary broker dealers. But you would need to buy long-term treasuries as much as you possibly could, because when that gets announced, it'll be just like when they announced buying corporate bonds in COVID, where all of a sudden the corporate bond market went from down, 20 points to right back to where it started in just a matter of a few days. You could get a 20-point rally on the long bond if they announced that they're buying the long bond. That would be a 100 basis point drop.
You said that if the Fed were to cut rates, that might cause a sell-off in 30-year treasuries.
It's already happening. They started cutting rates September of 2023, and the long bond has gone up in yield significantly since then, 100 basis points.
And you think that will happen again?
Why not? I mean, it's a paradigm shift. We have a tremendous paradigm shift that's going on, where money is not coming into the United States, where the long bond is not a flight to quality asset. Gold suddenly is the flight to quality asset. People, I think Costco is selling gold retail and they can't keep it in stock, and gold has gone from, it was living at $1,800 an ounce not very long ago. And once it broke above 2,000, it was just straight up. And now it's basically a third of 10,000. 3,333 and 33 cents it was actually when I looked at it yesterday. So I think gold is a real asset class. It's no longer for lunatic survivalists and wild speculators. It's viewed as an asset class, and central banks have been accumulating gold. Gold was stuck in the mud because for a decade or more, central banks were selling it down. They've bought it all back.
So are you buying gold?
I've owned gold since it was $300, and I also own some gold miners personally. But they bought it all back. It's amazing. They sold it at like $300, $400, and they're buying it back at $3,000. See, central banks are not very good long-term investors.
Well, maybe they could use advice from you. One thing that we've been hearing.
Okay, so I just want to talk about 2 points here that they made on the bonds, and then also about gold. So again, kind of what we're looking at here is a long-term cycle where dollar's probably going to be losing value, and usually when the dollar's losing value like that, it's not good for the markets. So you can kind of see the last couple of times we've had a peak in the dollar was also coincident with a peak in U.S. stocks. So is that going to be the case again? I don't know for sure. Nobody does. But it's something to look at. But as we talk about two things, gold, and then he talked about when to buy the 30-year, when quantitative easing comes back from the Fed, because at some point rates are going to get so high that the Federal Reserve is just going to say, all right, we're going to buy long-dated bonds and we'll pay 4% for a long-dated bond if it's at 6, or if it's at 6, they might even say we'll pay 3%. At that point, we have two issues. The biggest one is going to be inflation, because that is going to be inflationary. I don't care what you say, at that point, we're looking at some serious inflation. And one place you could go when they announce quantitative easing is in the long dated bonds, because if the rates come down due to the Fed buying at artificially low rates, the bonds are going to go up in value. Remember, bond yields and bond values are sort of a seesaw. They work the opposite. So when rates come down, the price of the bond goes up. So a lot of people forget that. But the other thing that you look at is sort of what he mentioned, gold or commodities, things that tend to do very well in inflationary periods. And I've been showing people, like, based on a commodities to equities. So this isn't focused strictly on gold, but on commodities in general. So we're talking energy here. We're talking livestock, grains, industrial metals, precious metals. It's actually kind of at a cycle where we usually see some sort of period where commodities outperform naturally. But then if you throw on top of that any kind of action by the Federal Reserve to step in and manipulate markets a little bit on bonds, which is essentially money printing, we could have a period of some serious inflation, and you're going to want to be invested to protect yourself. And this is another chart that I use quite a bit. It goes back to 2007, but kind of just gives you a general year by year performance of commodities, gold, and the S&P 500. And you can kind of see here, how they perform. And there's a lot of variables or variation with these asset classes. But what you can see is by adding commodities and gold to a portfolio, you're going to actually reduce the volatility of your portfolio overall. The big one there, if you look at 2008, when both commodities and stocks were down sizably, gold was up. And then there's periods where stocks really crush it and commodities and gold get hammered. But there's periods where commodities and gold do quite well and the stock market struggles. So even from an asset allocation standpoint, it's always good to have some commodities and gold. I've always got a little bit allocated to it. But if we start to see the Fed do quantitative easing, then it's probably going to be even more important to focus on, having those kind of assets in your portfolio. All right, let's jump back to Jeffrey and let him chat a little bit more.
Hearing about in a number of the panels this morning has been about the corporate debt market.
Yeah.
And one thing that I've gathered from talking with people at Doubleline and reading your outlooks is that you've reduced your allocation to below investment grade credit.
Systematically over a 2-year period.
To the lowest level, I believe, since the inception of Doubleline.
That's right. We have higher quality portfolios today relative to strategy style than at any time. We run closed-end funds that are leveraged. We have the lowest leverage of all time. We had 45% leverage versus net assets, and in one of our funds we're at 7. And we're there because we want to be a liquidity provider when you get paid to be a liquidity provider, and you're not now. The spreads are very uninteresting in the credit market. Just as the valuation of the S&P 500 is incredibly uninteresting. When we had the big sell-off in April, people were like, yeah, we were kind of asleep at the switch. The market was really overvalued. We really should have been thinking more cautiously. Well, it's more overvalued today because the S&P 500 is down 1 or 2%, and earnings estimates have been cut significantly. So if you look at the forward PE, it's higher now than it was at the all-time high back in February or early March.
So two things there. First off, again, he's a bond investor. And like I said, the bond market drives all the markets, including the stock market. So what he's seeing, that the spread between treasuries and junk bonds is as low as it's been. So you're not getting much additional yield on junk bonds as you are from treasuries. So he has reduced his exposure to lower quality bonds. He's also, even in leveraged funds, he's taken it as low as it's ever been. So this tells you that he's expecting some headwinds here going forward. And the thing is, if you look historically, I don't have a chart for this, but if you look historically, the spread between junk bonds and treasuries really goes up when the stock market struggles. In fact, it kind of leads the stock market. So when you see the spread go up, that also is usually a sign that the stock market's going to have some issues. So it's really not there yet. But what he's looking at is, hey, we have stocks that are extremely rich valuations. They're back to all-time highs. This is a little bit dated, so we're already back to all-time highs. Market's up a couple percent for the year. But yet companies are cutting their earnings estimates. And in fact, even FedEx this week said they're not even going to give any more estimates for the year. That's how kind of uncertain it is for them. And you're not getting compensated to do junk bonds. So it's a precarious time, according to one of the smartest guys on Wall Street.
What are you sort of anticipating? What kind of...
I anticipate a great buying opportunity. I don't know when it's going to happen, but it's getting close. I feel that the environment feels a lot like 1999 relative to AI is just map over .com for AI. I also think it feels a lot like 2006, 2007. It's funny. One of the hardest things to do in the investment business is to learn and fully appreciate how long everything takes to happen. It takes forever for the problems to actually show up. It takes forever to the defaults to finally arrive. But people anticipate changes with great enthusiasm. So AI, of course, was embraced with great enthusiasm. Electricity was all the rage back in 1900 because people realized that electricity could change the world. And I think we can all agree electricity changed the world in ways that are bigger than AI will change the world, in my opinion. Electricity is like amazing. But there was a huge boom in electricity stocks in the first decade of the 20th century. But electricity stocks boomed so much that their relative performance peaked versus the stock market excluding electricity stocks in 1911. If you own electricity stocks, you've been underperforming the non-electricity stocks since 1911. That's a long time. And that's what happens. That happened with the dot-coms too. That was the 1999 thing. Sure, it turned out that some of those stocks were great investments, but that enthusiasm becomes very excessive. They see the possibilities, but it takes a long time for the possibilities to arrive. It's taking a long time for the tariffs to arrive.
So do you think that the tech stocks that have been outperforming are going to lag behind in terms of the 99 performance and sort of the corollary of all of the credit investments tied to the AI build out also?
Yeah, it's a momentum trade, and momentum trades always to decide that their first loss is their best loss, and it turns into a seller's market.
You talk about 2006, 2007. That's a credit event.
And I've been talking about that for a long time. I've been underweight the Mag 7 for a couple of years, and it certainly hurt performance. But I'm looking from a risk standpoint. People forget that when you're an investor, you not just want to focus on returns. You need to focus on risk, and the risk is as high as it's ever been in the AI associated companies. And it doesn't mean that they're not great companies. It's just that they've overextended where they are. I mean, Tesla trading at a couple hundred times earnings, and everybody talks about the story of Tesla. The robots are going to be out there soon, and self-driving cars, blah blah blah. But their earnings and sales have been flat for a couple of years. And if the markets ever get to the point where they expect earnings and not the sizzle, the story, it could get ugly.
Mm-hmm. And when we took that poll that my colleague Danny was pointing to, private credit seemed to be the spot where people expect defaults to really pick up.
Yeah.
Do you agree? Do you think that that's
Sure.
sort of the epicenter of some of the risk?
Sure. The CDO market in the mid part of the OOs, where there's just tremendous issuance, there's tremendous acceptance, there's all kinds of, I was listening briefly to the private credit panel here, and there's a lot of phraseology that I heard that reminded me of CDO panels in 2006, 2007. Just complexity, illiquidity, tensions between investor classes. These things, private credit is extremely heavily invested in. You know, Harvard University, bond market twice because they didn't have enough money. They have $53 billion and they can't pay for repairs. They can't pay for operating expenses. They came to the bond market looking for $2.5 billion. I think they got $1.5 billion. And then they came back again. And I think it was last week, it was announced that Harvard is thinking about selling some of their private equity interests at a discount, obviously, because when you're a forced seller, you're not going to get your cost. And so there's a lot of overinvestment. When I speak to RIAs, you know, people that manage kind of higher net worth retail money, for the past 3-4 years, one of the very first questions, without exception, what about private credit? And I say, are you heavily invested in private credit? Yes, and everybody is. And I say, so, you know, what's the argument? And I was giving a speech down in Texas, and the woman before me was from a fund that's very heavily involved in private credit. And she basically gave a sales pitch for private credit, and it's basically a 3-pointed sales pitch, none of which of the points really sell me. The first is that it's less volatile. It's a Sharpe ratio argument. So, you know, and we all know it's only because they don't mark them to market. I mean, everybody knows that. So it's just like private equity. If the S&P 500 goes from 100 to 50, they mark their private equity down to 20 points. And then they both recover over time. They both go up to 100. So look at that. They have the same return, but the S&P had double the volatility and then some. That argument is not valid. You can't. They aren't marked to market. So, you know, the next argument is somewhat valid. Historical performance. Private credit had some very good years. It was quite cheap, you know, 5 or 7 years ago. It's good, and it's true. But as we all know, as they say in the disclaimers at the commercials, you know, past performance is no guarantee of future results. Quarters at least now. So it's already changing. So I think that there's a lot of overinvestment in private credit, and the liquidity is not very good. And I just don't think the excess reward is anything close to what it used to be. So I would view that as a place where there would be forced selling. Harvard could turn into a forced seller. And Harvard, you know, they at least used to have like the best reputation. Yale had this great reputation for investing in private markets, and that lured in a lot of Me Too behavior because they were emulating the results of Yale. But there's once one university is publicly acknowledging that they have liquidity problems, I've got news for you. If you have a cockroach in the kitchen, there's never one cockroach.
Yeah, so I've done a presentation on private equity and private credit. I'm not going to get too much into it, but essentially what I said is I think it's going to be the trigger for the next big bust. Nobody knows for sure, but there's just been such reckless use of this stuff. And actually this private credit, meaning it's not publicly traded. You can't go to Schwab or Fidelity and get the credit. You know, it's just not there. It's something that's privately owned, not publicly traded. And the private equity has been creating a lot of this private credit. That's why and I talked about this in the previous presentation, that's why companies like Joann's and Red Lobster and all this went under, is because private equity forced these companies to issue tons of debt way beyond what they could actually afford, but they pulled that money out and rewarded their investors with it. But they took that private credit, put it into a bunch of tranches, and then sold it to pension funds and endowments and everything like that. And that's probably going to be the next bust. And Gundlach's kind of getting towards that. It was a great idea at the start. Got some pretty good returns on it, but it's kind of Frankensteined itself. So that's probably where I think the next sort of bust is going to show up. But we'll see. Who knows?
We manage a lot of other people's money, and a lot of it is in the fixed income market. We're just protecting and waiting for much better opportunities. When I think about it, markets take the stairs up and the elevator down, which means they go up faster than they go down faster than they go up. And so when it really breaks, it's not down a couple of points. Even what we saw in April, that's not a real break of the credit market. The real break of the credit market is bonds drop 30 points. And everyone thinks they're cheap, but they have to sell. So you have an opportunity at some point to buy bonds down. I don't know. Let's just say it's 25 points. High yield bonds yield about 2.5% more than Treasury bonds. So if it takes 10 years for that 25-point opportunity, you're going to break even. And it's not going to take 10 years. It's not going to take 5 years. I believe, but the panel before me said, I think is true. I think 27, 28 are going to be, are likely to be a window of tremendous opportunity. Because I think by then, the Treasury problem will be even more in focus than it is today. And I think that it'll weigh upon market behavior. We need to restructure a lot of things in our system. We need to restructure institutions. We need to restructure political parties. We need to restructure our finances. All these things have been in place. It's the waves of history. Neil Howe calls it the fourth turning. He wrote a book called The Fourth Turning in the mid-90s, predicting the credit crisis around 2006 using demography. Pretty good. And I know him pretty well, and we talk about it, and we have the same concepts, and that is that societies start with a pact. They have an economic system that produces things, and then they have, so that's the means of production, and then they have the property relations that split up the rewards. And when it starts out, and this would be, say, right after World War II or after the Civil War, it starts out that everybody kind of buys into how the system works. But there's a fundamental problem with this kind of duality of property relations and the means of production. Means of production change in revolutionary ways. Steam engine, radio, television, telephone, internet, AI. They're just explosions of innovation. But the property relations, they don't change very quickly. In fact, they're barely evolutionary in the way they change, because over time, this becomes a wealth inequality, which of course we're in an extreme, where the people that benefit from the property relations, they don't want them to change because they're winning. So when you have tremendous concentration of wealth and power, the property relations become calcified. And meanwhile, the means of production are causing all kinds of disruption and intensifying the wealth inequality. And then suddenly the whole thing says, this doesn't work. We have to get the property relations to a right place where this isn't a feudal system, where there's the lords and the serfs. But that's what we have. And so we need to rejigger all of this stuff. So, and the Treasury debt problem, the interest expense unaffordability, is another offshoot.
So I've been talking about the fourth turning for a long time now. And I'm not going to get into it too much, but I pretty much agree with everything they said. So essentially at the fourth turning, you have pretty sizable revolutions, if you will. A lot of these things change the social structure again. I've always said, listening to Neil Howe, the author, one of the authors of the fourth turning, he said when he wrote it in the mid-90s, nobody believed him that it was going to happen. And he says now when he talks about it, nobody believes him that we're going to get through it and come out better on the other side. So while it might stink here a little bit, you got to remember once we get through it, it should be much better. But the other thing I just wanted to point out, when Gundlach saying he's expecting 27, 28 to be a period where you might have some upheavals and much better time to invest. And that certainly could be true, and I would never go against anything Gundlach says, but I keep thinking a lot of these issues have been here for a little while, and I always think about that Hemingway quote from The Sun Also Rises when they said, well, how did you go bankrupt? And the response was slowly, then suddenly. So this thing can pop up pretty quickly, and like he said, things take an elevator down, they take the stairs up, but the elevator down. So maybe 27, 28, maybe later, but it could be sooner too, because these inefficiencies have been here for a while. Okay, so we'll finish up here real quick with.
We're almost out of time, and I could speak with you for an hour, but I want to finish with the idea that is this a United States problem or is this a global problem? Can you hide by going to invest in places like, say, Europe or Japan?
You can hide to a certain extent. I don't think you can become immune. I think the way to invest in periods like this, I think, are to go with long-term themes. And a long-term theme that I think is one of the most bankable, and it might take in 30 should invest in India, because India has a similar profile today to where China was 35 years ago, when they had tremendous population, labor force, visibility of labor force growth, tremendous problems, a gummed up legal system, corruption all over the place. China went from 1/12 of the US GDP to 70–80% of US GDP, and they certainly produce more goods than the United States, so in a certain sense, they're bigger. Well, India has the same demographic outlook as China did then, and being moved around. For manufacturing can come there. They're very technology. They have a long history of being, a significant society. So I don't know how long it's going to take, but that's one that you buy, and you just do yourself a favor and don't open the statement, because if you for your grandchildren's college fund, and that'll work. So there are places to hide. A source of growth. If you were a Bitcoin person, I would recommend, instead of being a Bitcoin person, you would take the same unit of volatility by buying gold and leveraging it, probably, even though Bitcoin's done very well. And for the last 12 months, Bitcoin has outperformed gold, but they're both up 40+%. Those are the places to be. And then dollar-based investors should be investing in foreign currencies. The S&P 500 has stopped outperforming the MSCI Europe, and it's underperforming in a major way on a year-to-date basis. And that took a while to happen. But things always take longer than people think, but it's happening in real time. And the next one will be selected emerging market equities as opposed to the United States, because the emerging markets will have the same benefit broadly as India does most specifically, but you also win on the currency translation if you're a dollar-based investor. So we are, for the first time in a long time, starting to introduce foreign currencies into our funds, even ones that are owned by dollar-based investors.
Okay, so that's the end of the presentation there. Again, he kind of hit on some topics there. Gold being a good investment, obviously international stocks. He's really big on India. I've been adding small bits of India. A fund I've interviewed Kevin Carter, who operates an ETF that tries to focus on the next Amazons and Ubers and all that in India, the sort of the online markets, trying to replicate that in India. So that's something to look at. But those are some of the areas that he's focused on. And I agree with them. And then as far as the Bitcoin, so gold's been proven and central banks are buying tons of gold. And like he says, if you want kind of a Bitcoin performance, just take your gold and leverage it, because the Bitcoin is extremely volatile. It's almost like a 3 times NASDAQ holding. And so you could do the same with gold. One of the ways you can leverage a gold holding is to actually buy gold miners, because when you look at it, it's almost got 3 times the volatility of gold. So that's another way to approach it. So if you don't want to do Bitcoin, and I totally understand that, I think gold's probably going to be better anyway, honestly. So I just wanted to kind of throw one of the smartest guys on Wall Street, put this out there, throw in some of my comments with it. But whenever somebody like Gundlach takes the time to talk, you really should listen.